I think we're actually a couple minutes ahead of schedule, so that's a very good place to be. This is always a very lively panel that we have here, so we'll probably need those extra 3 minutes. For those of you who don't know me, I'm Jim Matthews, and I manage the CRA Strategy and Program Management team for Capital One. We're very pleased to have all three of the prudential agencies represented today. We have Theresa Stark from the Federal Reserve, Patience Singleton from the FDIC, and Bobbie Kennedy from the OCC. And we're going to try to make this as interactive as possible with the audience, so prepare your questions, in other words. But we are going to start out with maybe asking each of them to tell us a little bit about what their top 2 or 3 priorities are within their agency as it pertains to CRA. And I'll ask Theresa if she wants to start that discussion. And you can also elaborate on the work that you actually do within the agencies. The biographies, of course, are included in your packets, but if you want to give a little more detail for some of the folks that don't know you.
Okay, well, thank you. Top 2 or 3, I'm hoping at least 1 or 2 of these will be repetitive as we go along the way.
I know,
because
right? I think we all have the same priorities.
Well, that may be a good thing.
Yeah. Well, we hope so. The idea is that CRA is an interagency regulation, and so we spend time together trying to make sure that it is something that we're working to, if we make changes to policy, that we do it together. So right now, I would say our top priorities are, as we speak, doing a full evaluation of the examination procedures and reviewing them and revising them. And when I say revising, obviously the regulation is the same, but there's a lot that's in guidance, and the guidance in terms of the Q&A document that we revise periodically is very large, and the procedures they've been revised, but only in like small segments and very infrequently. We thought it would be good to provide, just in the interest of consistency, a little more detail, a little more of that guidance that's in the Q's and A's into the exam procedures, and that's something that we're all working on right now. And then I would say from the Federal Reserve perspective, we had also thought that it would be a good time to help examiners by, and this again, interagency, but we have some IT people at the Fed that we thought would be helpful to the interagency process, and we're working on creating some new tools to make it a little more efficient for examiners to do things like community contacts and evaluate community development activities. And so, and I can't say that I think that we were keeping up with technology or anything like that over the years. And so we've got some really good, I was happy to find, good IT people on some projects for us. And so probably nothing will be apparent to anybody else, even though we've been working on it for several months now, until maybe late next year, hopefully. So I would say, and there are 2 of those, so I'm going to say that that's 3 things, okay?
2 technology projects?
Well, I mean, no, actually, it's 1 shared database with 2 parts to it. And, but I think that
So the community contacts and then community development
data, yeah, sort of an evaluation tool where we could, because right now, examiners have created their own way of dealing with how they go through community development activities, and they've created their own spreadsheets and databases and things like that. But one of the things that they've also done is sort of done it in the moment at a particular exam, and then they file it away with their work papers, and that's the end of that. And so it seems like that's a pretty rich source of information about what performance context information, really, because when next time you go into a particular place or a particular bank, it'd be nice to know what else is happening there. And that's something that, I mean, as all of you who have ever submitted comments that say, so how much is enough when it comes to qualified investments? Hopefully this will help us. It's limited in that we're not suggesting that banks collect this on their own. But we know that because of the definition of community development being so detailed, that the examiners have seen the need to lay out all those different little markers that one has to go to in the definition and evaluate every activity based on that. And so they've come up with these tools, and we got a group of them at the Fed together to see what things they really thought were necessary and put that down. And so we're developing it, and we're hoping that we'll get a little bit further along in the other. We've talked about it with the other agencies, but we're kind of taking the lead on it because, to be quite honest, I think we managed to. It's an area where we thought we could contribit, and
you were able to identify the resources.
Yes, and get the budget for it. It's something we've been talking about for a while, but it takes a bit. But we're in the middle of it now.
Well, thank you. Patience.
I'll begin, like I said, just sort of reiterating what Theresa said as it relates to the examination procedure. We're meeting on an interagency basis, and I don't want to say how many hours per week that we spend together. We miss Bobbie.
I don't know. I do not know her favorite color yet, so we could still meet more.
I mean, anywhere between 6 to 10 hours. We're all in a room together every week working on the exam procedures. It's a priority. We're hoping to get them out as soon as possible, but there isn't sort of a date certain. As far as the FDIC, I think.
Now, excuse me, Patience. Did you say there is or is not?
I'm sorry. There is not a date certain.
Okay.
For
I had
us
my hopes
to-
up for a second.
No, all I can say at this point is that we are working diligently and spending a lot of hours on the examination procedures. That's a huge priority for all of the agencies. So with respect to sort of other agency priorities, at least from the FDIC, I think everyone's sort of aware that we will be having at some point a change in leadership at the FDIC. So I'm not quite sure what next year pertains for us, but I do.
That change is not too far away, right?
Oh, well, I think Marty leaves at the end of the month. Well, his
Right,
term is
yes.
up at the end of the month, but he still could serve as a member of the board. So again, it's in flux. We have no idea who will be coming in and when. But that said, what we have been focused on for the last, I guess, couple of months is sort of there's a team put together by a director, Pierce, related to hurricane relief. And I know there's probably going to be a question coming up about what type of CRA credit institutions may receive for their efforts to help folks in Texas, the Virgin Islands, and other parts of the Caribbean. So that's sort of another priority. And earlier this year, again, in the FDIC's search to be responsive to some industry concerns and some concerns, obviously, by the consumer groups, we put out guidance related to full and limited scope. There are these concerns that rural areas, non-metropolitan communities don't receive sufficient attention during the examination process. So in an attempt to address that, we released some guidance which requires examiners to pick an additional assessment area if that assessment area has not been selected in the last 2 examination cycles. And it's an attempt to allow an attempt to allow the regulators to select neighborhoods or communities that have not been thoroughly, I guess, I don't know if I should say thoroughly, but have not been examined utilizing the full scope procedures.
More comprehensive.
Yeah, I know, right? Comprehensive is a better, not as loaded word. So that's where we are with respect to the FDIC. I'm here to answer your questions.
Thank you, Patience. And Bobbie?
I'm in a slightly different role. While Vonda would agree
Yeah.
with everything you said,
Yeah.
I now oversee compliance supervision management for CRA and fair lending. And so I'm actually working with the boots on the ground. I introduced a vision statement, which I should maybe have brought and read to you guys, but essentially I want my team to provide a value-added supervisory experience. And so we're working hand in hand with the examiners in the field, providing them instantaneous guidance, working with them to address the procedural changes that we're working on. We had a process memo that came out in roughly March, I believe it was this year, that revised some of the approaches that we're taking. And we have a policy memo that's on the Comptroller's desk, as I understand it, at this point. we're really trying to address some of the concerns that the industry has raised over the years pertaining to assessment areas and full scope selection, the gamut, broader statewide, regional area, all of those sorts of issues. We're really trying to execute on some of the things that have existed in the exam procedures for a long time, but that we haven't been doing as well as we could have or should have. Probably the other big focus is really, recognizing the skill gap and providing that support, but also revising, we've had some very rote language. Anybody who's read large bank PE from the OCC within the last decade will probably be very familiar with the language that talks about the proportion of loans to low-income borrowers is less than or more than, or it's good, bad, or indifferent compared to the demographic, and the market share is X, Y, or Z, and it all rolls up. And in some cases, in one PE, just within the geographic distribution discussion, there were 38 adjectives ranging from excellent to very poor, and you had no way of knowing how that rolled up into the rating. And so what we're focused on doing is getting away from that rote language and instead allowing the reader to look at the data. You arrive at your conclusions, and then we explain to you the factors that we think are most significant in contributing to the rating beyond those distributions. So, if in New York City, everybody knows the cost of housing is extremely high. So the opportunity to lend to LMI borrowers or in LMI census tracts on 1 to 4 family housing, it just is so limited. You have to go to really some far-reaching areas. I was talking to somebody the other day who said something that really kind of surprised me, because they were going on in glowing terms about, oh yeah, we got this condo in Bed-Stuy, and I was like, 20 years ago when I lived in New York, you didn't go in Bed-Stuy if you could avoid it. And so to see that kind of transition and the impact that that has on the affordability of housing and who is able to live in these communities, and particularly who's able to purchase, we need to be capturing more of that in our discussions of why we think your performance is whatever level it happens to be, rather than just trying to massage the numbers in a way that, well, yeah, we know there isn't a lot of opportunity in these markets because of the cost. Let's talk about that and make it more transparent and clear to the readers, to the banks as well, what we're thinking. And one of the key things that we're focused on too is addressing that, the gap. I did some analysis from my bosses recently that showed some really, between the time the last performance evaluation was started to the date the current one got to my team, is just stunning in some cases. And it's just, we don't consider it acceptable. And so we're working to implement a process that would, let's time the exams start to start. And that way the banks know what their schedule is, they know when to anticipate reports, they know when to expect the examiner's visit, et cetera.
Well, thank you all. It seems like you're all very busy, which is a good thing, and especially around the examiner guidance. So I know one of the challenges that banks generally have in that space is a lot of the minutia. And sometimes it's necessary because CRA can be very nuanced, no question about that. But do any of you have thoughts or things that you're actually doing to maybe try to simplify procedures or processes to kind of relieve some of that burden from banks so that they can spend more of those resources actually getting good things done in their communities? Any thoughts on that?
Well, I know Vonda and I had a discussion just yesterday about the issue of the naturally occurring affordable housing and how do we qualify that.
Which is a very important issue for
Yeah,
NAAHL and the people in this room.
Yeah, and if we see some of the changes that we're hearing about in some of this legislation, the tax bill, et cetera, and issues of budget cuts, that may be a more significant way. But, I have raised several articles that I've read in the last few weeks talking about, looking at the ACS data, that one of the interesting new trends is that while we've seen rural depletion for a long time with the net outflow of population, with the brain drain, people go off to college, never come back, what we're starting to see that in a significant way in suburban areas as well, that the metropolitan core is experiencing growth. You've got the millennials who are choosing to live in the city. I think that reduces the burden of the designated driver, maybe? I don't know. I remember
Well, you think that might be the key driver then?
when I was little, I remember people coming over to my parents for cocktail parties and then driving home. And, that was, so, 40, 50 years later, it's a completely different environment. I don't know that that's really the difference, but there are a lot of factors driving that. And then you've got people at the retirement age who are looking for those amenities and the access to all the facilities and the transportation and the medical care and all the other things that you benefit from living in the urban core. And so you're actually seeing these numbers that are showing a decline in suburban populations as well. And with all of that, increased pressure on the affordability of housing that's only exacerbating the problems that have existed for years.
And so what are you and Vonda suggesting in that space to make it easier, Bobbie?
Well, my recommendation is that, obviously we don't envision requiring additional data collection in order to, be able to identify, so occasionally I'll have people ask me, examiners ask questions about, well, shouldn't they have to get the income of the tenants? Well, what would happen if you went to the tenants and as a landlord and said, hey, Jeff, I want to know what your current income is because I need to tell the bank so that they can get CRA credit. Like, I
really don't want it to raise your rent.
But I know you're going to raise my rent, yeah. And so, hey, they're not going to tell Jeff, the landlord, what their current income is, because they don't want that adverse impact. Hey, well, you can afford much more in rent. And it's an added burden that's unnecessary. So we're looking at, and I think in several cases over the past 4 years or so, advising examiners in there, they sample some of these transactions. So, looking at the specific demography of that census tract, what's the proportion of LMI that reside in those census tracts? What is the, for the MSA, what's the 30% of income that would reflect an affordable rent, and how does that play in across those activities so that, we have a better sense of whether those properties are likely to be serving those segments of the population. And if you see a relatively high concentration of LMI or in high-cost areas, middle income families within that census tract, I think you can be reasonably certain that if the rents fall below that 30% threshold, you're likely, that property is likely serving that constituency.
It sounds very close to
What
something
you wrote
I
down?
recall from NAAHL, I believe.
Yes, yeah, and I don't think that we're far apart on that issue. It's just getting people to have the comfort level of, what the purpose of this housing is.
Just be careful, though. I did hear one of our members, I won't mention any names, or I won't mention the agency, where this discussion came up, and the examiner was requiring, in order for it to be considered in a middle or upper income census tract, more than half of the population had to be LMI. Mathematically, I don't know how you do that.
Yeah,
because we're talking about medians here.
Yeah, there are some census tracts in New York City and Chicago that get to around 45% LMI that are at least middle income and maybe lower tier upper income, but that's more the exception to the rule. And one of the things examiners should be looking at is whether that's a high cost area. If you're in LA, Chicago, New York, I recall a discussion with an examiner that said, well, the bank didn't prove that New York was a high-cost area. And it's like, I don't think that there's much work that needs to be done there to arrive at that conclusion. So now if you came to me and said, well, Boise is a high-cost area, that I'd need to see. But I can pretty much intuitively surmise that New York, Chicago, LA, Boston, Washington,
San Francisco.
San Francisco, increasingly Atlanta, that there are these metropolitan cores that are getting to be very costly. And the problem is if we don't allow consideration of those activities, we don't encourage banks to engage in those activities. Some banks have said that, well, if I can't get consideration for it, I don't do this line of business, because I'm doing it as part of my CRA obligations. And so it doesn't make sense for me to commit this money in an area of expertise that is time-consuming, only to have you say, no, you haven't proven us to be beyond a reasonable doubt. And I don't think that was ever the standard. And so, that's my personal view, but I think that we're working very diligently inside, and I know Vonda is the counterpart with the agency group now. So, hopefully we come up with something that really streamlines the process so that we accomplish the benefit for the communities without necessarily giving away the store.
Yeah, I think that's where we are. I mean, there haven't been a ton of conversations about this within the interagency group. We've met with NAAHL on a couple of occasions to discuss it. And then myself and Jonathan Miller, we've expressed some of the concern, right, that we're really supportive of the concept, but how do we make sure that just because it's affordable to low-income people, that low-income people are actually getting the benefit and living in the development. So I think that's where
Right, and I think
that's where we are. We haven't been able to sort of close that, but we're working on it internally.
And I think that's what's great about the NAAHL proposal, because it does look at those additional characteristics at the census tract level. That gives you a pretty high comfort level. If the greatest proportion of the renters are LMI and you have basically affordable rents within that census tract as well, you're probably not in an area that is gentrifying or on the edge of gentrifying. So I think that's one of the great things about pulling that additional data together to build the case.
Yeah, and also, I don't want us to, obviously regulate based on anecdote, but I do know people who rent downwards, and if it's affordable apartment and they're students, they're going to get the affordable. They're going to go for the affordable house.
Yeah, and
there's just a high income.
And there's nothing worse from a banking perspective than policy by anecdote, right?
So just to say that, but I think that we're all in the same general ballpark, right? But there's still some concerns about the people you want to benefit,
and
actually
the other
being the beneficiaries, and the fact that banks, if it's naturally occurring, aren't they going to make the loans? Anyway,
but it's still important that they're providing the financing. And the other thing is, the CRA is never intended to be an exact science either. Oh, no. So you're always going to have some exceptions, but you have to balance those two to come to something that really suits the need there 90% of the time. But anyway, all right, I think I did my job. I got them warmed up. So what questions do you have now from the audience here? Mr. Olson.
Hi, good afternoon. It's always seemed like one of the perennial issues around CRA is people not knowing for sure whether something's going to qualify or not. And we've talked about that a lot, where as bankers we tend to be a little risk averse. If we're not really sure, if it's on the edge and we think we may not get CRA credit for it, chances are we're going to pass on it. So my question for you all is, has there been any discussion amongst the agencies of developing some kind of mechanism? And I know you probably don't want to go back, decades ago to when all those letters, the interpretive letters would come out periodically. I don't know if that was the best system, but has there been some discussion, some way for us to submit something for review or ask a question and find out in advance and have a little more certainty about what will qualify?
So, those letters were, they weren't very workable, and we developed the Q&A guidances to take in all of those letters everything that was ever written in a preamble, put it in one place. The hardest part, I mean, when I started in CRA, I worked for the Office of Thrift Supervision, and that was in some ways a little bit easier in that most everyone was in the same product line, which was mortgages. And I would always encourage people to actually talk to the bank, or to the region, their examiners. Talk to the examiners themselves, see, to get, because I felt like there, and I'm sure it's true at the Federal Reserve too, that examiners are sort of frontline training for bankers often on certain things, like how these rules would apply. And if you do it in the region that you are examined in, then you're going to have a very sort of closer to the ground interpretation of the rules. If in fact you think that that's wrong, then come to DC and ask in the policy area. But I think to the point of everything that we've been talking about, one of the big impetuses and reasons we've had on our minds for a long time reviewing and revising these exam procedures is to put enough guidance in them that we narrow the number of questions and number of judgments that one has to make, and hopefully address, which is not to say that it's gonna, we're not gonna have.
Well, we don't want it to be too prescriptive.
Exactly.
Because you still have to have that flexibility for things that nobody is considering right now.
But I think we often feel as though that we are concerned, I guess, that, that our examiners are really relying on things that are written down, and what if they missed something and didn't know, and we, to go back to the three, there's the secondary list of, I guess, the items 4 through 7 or
38.
something, right, yeah, 6, whatever, that we have, and as soon as we are done with the exam procedures, we think it's very important to revisit the template for writing PEs, so that, because I think some of this is not understanding whether or not something was considered, because it's not very clear from the written document whether it was. And then, of course, there's the kind of holy grail of training, more interagency training. And I think that's where it's really going to be an important thing to bring people together to more. And this is true internally and externally. I mean, we have a training regimen, yes, but I think that we could do more. As a general matter, having been involved in CRA, when we wrote these regulations the first time in the early 90s, I just feel like every good tree gets pruned, and CRA kind of went along for a while without a good gardener. So that's a lot of what we're trying to do, is to really kind of.
I think all of those are great, but I know the one concern that banks often have is often the local examiner will be reluctant to actually stick their neck out and say, yes, this is going to qualify. Or sometimes also you have the concern that you may get that answer from the local examiner, but they might not be the one who conducts the exam the next time around.
Yeah.
So
we'll try to address as many of the big, bolder things that are always questions. I don't see us getting into tell me if I'm wrong, into the letter writing about each little thing and blessing each little thing. I think that's difficult. I don't think we're staffed for it, because as much burden and staffing issues as banks have, that's kind of what the government's got too. And I think we do want to have guidance that's clear and flexible, but can apply.
Yeah, just reiterating that. I think, just the new examination procedures, I think that will cut down dramatically on some of the inconsistencies that you're finding in the examination.
And what's the date those are coming out again?
Well, we haven't gotten to the naturally occurring affordable housing yet.
We haven't gotten to that yet.
It's the date after the day before the date. Well, I think we have that. We've had some experiences recently with some groups that wanted an activity to, they wanted an opinion on whether something qualified, and we told them, well, we don't issue blanket determinations. However, based on the information you've presented, we don't think it would qualify. They came back with more information that still didn't support the issue of it. I think we went back and forth at least half a dozen times with probably a dozen people at the agency involved in these discussions over the course of that time. and it becomes a tremendous drain. And I think years ago, the agencies all got burned by falling in line under support of a pattern of community development activity that seemed like a great way at the time, but turned out that very small amounts of the money was actually going to community development. And so it was incredibly inflating in terms of what was, and I think that was a stinging experience for us. But again, we really don't have those resources to sit there and opine on every possible iteration, because we could get them from the smallest institutions on up, from every community group and any lawyer looking to promote a specific product. So it's just too cumbersome to go with that individual approval approach.
Yeah, and even with respect to specific examples, sometimes you want the certainty, right? We have like examples in our Q's and A's, but sometimes that actually ends up limiting the institution's credit, right? Because some examiners see that list, and even though it says the list isn't exhaustive, if your product is not on that list of examples, or your service, or your loan product, you don't get credit for it. So that's why it's sometimes not great to have lists. It's more to have sort of certain parameters, have parameters,
Illustrative.
and illustrative, have parameters, and have the examiner use some of their discretion.
And it
So
really
you
speaks
just
to the
gave me
need
an
for
idea.
training.
Yeah, right. Yeah, because I've heard numerous times they weren't given credit because the example wasn't in the Q&A.
Or the example becomes the rule.
Yeah,
So
exactly.
now,
An example becomes the rule.
As my time working on this gets shorter, I think,
Well, it's getting shorter for all of us, Theresa, just to clarify.
how could I actually leave in good conscience and do something new and innovative? And she just gave me an idea, which is we should have an app for our examiners on their little iPhones that they have, and every morning we could have them do a mantra, which is, lists are not exclusive. We could, or something.
We would support that.
I don't know how else to attack some of these things that we
Yeah.
say clearly.
Well, you talked about the examiner training, and I want to put this as a placeholder because, every time we've had meetings with the agencies through NAAHL or other trade organizations or individually, we always talk about the importance of training, but we also, I think, are going a step further with that now, where we actually think there should be specialized CRA examiners. But we'll put that as a placeholder because I know Mr. Agamirzadeh has a question as well.
Can you hear me? Reza Agamirza with Citizens Bank. Thank you all for being here. This is in context of the upcoming, regulatory examination guidelines and the changes to the HMDA that's going to be implemented in 2018. For some of us, the inclusion of HELOCs in HMDA reportable activity will have a major impact, and it will become the most prominent category of HMDA reportable loans. And as a product, traditionally, and by way of virtue of their features and benefits, it's not a product that's often used by low and moderate income constituency or properties in low and moderate income tracts, because there's not as much escalation in the pricing. With that background, have you guys given some thought in terms of how the evaluation will be conducted once the HELOC becomes HMDA reportable, and if you could share your thoughts with us?
Well, I guess I can start with the position I'm advocating, and we've had some discussions internally to OCC, but we haven't arrived at any formal decisions, and we've also had discussions across the agencies on how to handle this. The process that we're going to, we ran into a lot of problems over the last 20 years under the current regulatory structure in separating out purchase and refis. They often work counter-cyclically. So one is boom and the other is bust. And then we're going through these machinations to explain why, home purchase is doing well and refi is not. And, we want to get away from those discussions, so we want to consolidate the reviews into the categories of HMDA, small business, small farm, and consumer if it's applicable in limited circumstances. So of course, obviously that has implications for banks that have large volumes of HELOC loans once those become a component of the data. And there are two approaches. One, you go with a because they are so different, you pull them out. What I think we're leaning towards internally, at least, is having continue with the combined approach, but for those institutions that have a substantial portion of their lending in HELOCs, that we do a supplemental analysis where, so your HMDA data would be compared against all HMDA lenders, the aggregate data, as well as the demographic, but then if you're a substantial HELOC lender, we would look at just your HELOC performance against the aggregate HELOC performance so that we can see the comparable products and really talk about that more as part of the context so that we have a common baseline for all institutions, but recognize the differences between the market focus of different institutions and make sure that the obvious impacts of HELOCs, that you have to have equity in order to get a HELOC. And if you're in a community that has limited equity, obviously it's going to skew away from those communities. And we've seen that in data that we've analyzed for years. So I think that would be our preference, but that is still in the process of development because that won't be hitting the data for several years. And I think we want to try and have a common platform with the other agencies, so that that means that if their preference is strongly towards doing home purchase and refi as one category of analysis and HELOC separately, that may be where we end up.
So what about another option, though? Because as Reza mentioned, there are naturally differences when you're talking about home equity lending. Not just the equity issue, although that's probably the most significant, but a lot of people get home equity lines because of the tax advantages as well, which generally doesn't apply to lower income households. Because their standard deduction is going to be greater than their ability to itemize. Now, all of that may be changing with tax reform as well, but I don't think it's going to move in the direction where there would be more lower income folks that would be interested in home equity. Mm-hmm. The other challenge that banks have too is responsible home ownership, and we're not necessarily out there trying to ask people to take more equity out of their homes to finance vacations or things of that nature. So home equity lending certainly has its place, but what about the option where you just continue down the path that we have been on historically from a CRA perspective, where you take home equity loans out of the HMDA data and they're not considered at all unless they are a substantial portion of that bank's lending or the bank wants to opt them in. Because I don't think there's anything in the CRA regulation that says just because HMDA changed that they have to be included as part of the analysis.
Yeah, the question then is, what are the discussions at an interagency level about conforming changes to the CRA?
Yes, and
Yeah,
that's why we have all three of you represented here.
I was going to say, there are these discussions going on. Obviously, the FDIC, I don't think the feds have come down to an approach, and we definitely don't have an interagency position on this, but we are having those discussions, and a lot of these issues are coming up.
I had tried to make a pitch for people to send us comments on this issue, but nobody did.
We didn't. We got 2 comment letters.
I think you got at least one, and it wasn't from Capital One.
Who sent us? We had 2 comment letters.
But anyway, I think part of that was outlined. But anyway, it's a very important issue to get resolved because the new rules are coming into play here, and all of the responsibilities that the CRA officers have within their institutions to work with their lines of business, to understand again what the rules are going to be is very, very important. That clock's ticking very quickly.
And I would generally recommend that you at least do the preparations, lining up those discussion points, the performance context, so that you're prepared no matter which direction this ends up going, that you aren't suddenly caught with, oh, gee, well, now I have to go back and look at those patterns and explain why they're so different from the traditional
Right.
humdrum.
The only thing that I would say there too, Bobbie, is when we talk about performance context in this situation, it's sort of like the example that you gave earlier with New York City being a high-cost market. If every bank has the same performance context because now their home equity lending is included, then we have gone in the opposite direction of actually simplifying and putting the resources in the right places. But Reza, you wanted to follow up.
Just one clarifying question, Bobbie.
We only have one mic, apparently. We need to put Paul on skates.
Just one clarifying question, Bobbie. That supplemental analysis that you mentioned, I thought you said that it would be compared to the aggregate HELOC lender. So is the aggregate going to be the benchmark that will be leveraged for HELOC analysis?
Well, what we're trying to do is streamline the analysis portion of the lending so that we don't have our examiners bogged down in looking at 16,000 different cuts of the data. Once you start to stratify it by rating areas and multi-state MSAs and full scope and limited scope and everything else, it's just the fingers are going off in so many different directions that it becomes a mind-boggling exercise. And some of it is really not that necessary. So we're really trying to simplify the approach as much as possible and streamline that down. And so that our intent is to have, the lending that the institution does compared to the aggregate the aggregate industry performance, so that you have that more apples to apples comparison. But then you do have, with the HELOC issue, that raises a significant performance context issue that we need to wrap our minds around and figure out what's the best approach. And you're right, certainly that's one of the options is to leave it out or look at it separately. And so we're in the preliminary phases of discussing what that is, but from the standpoint of knowing the dynamism of the changes that are occurring in the regulatory space, I think the key is to keep this at its simplest possible form so that we can do these exercises, do the PEs more routinely, more quickly, get them back to the banks, give you the qualitative feedback that you need to be able to go to your boards and say, this is our CRA performance, this is, and this is what we need to set out or want to set out for the next period, and have a finite understanding of what that period's going to be.
Other questions? Oh, is that Bobbie?
It
Yes.
is. Yeah, Bobbie Salgado, Union Bank. I wanted to ask the regulators if, in the past, mortgage purchases and mortgage originations have had equal weight. Are you giving any thought to changing that moving forward?
That would be a regulatory change, first of all. It's in the regulation that we consider in the lending test, originations and purchases. So if we were to want to change that, we would have to amend the regulation.
And you're not thinking about amending the regulation right now?
No, we are not thinking about amending the regulation right now. So I think that's, for the now, that is the issue.
Other questions?
Go
ahead, Bobbie.
Real quick follow-up. So that doesn't come into play within your performance context, or are you giving examiners guidance to give that some consideration?
In what way? I mean, is there something specific that you're hearing about differentiating between?
Yes.
Okay, so tell me that.
You don't like my dancing?
Can you summarize your performance context in 10 words or less?
Our bank relies on purchasing mortgages in order for us to meet our goals, because we target wealth markets. And so we have been given some suggestion, if you will, that purchases will no longer equate to originations. So that has us a bit worried.
So the way I read the regulation is that there is no distinction. And like I said, I was around the last time, and I think that, or when these were created, and I think that the issue at the time, which may or may not, depending on the year, I feel like it's relevant or not. But the issue at the time was being able to give certain banks more liquidity. So, you know, sometimes the impression was that there are smaller community banks that are actually in communities that can underwrite these loans better than maybe a larger one further away. And if they have a place to sell those off, that provides more liquidity for neighborhoods. And that, you know, there was a time where I will confess, personally worry that maybe this reliance on purchases and the way that people are, like, you know, buying them rumoredly at the last minute before their exam and things like that, made me wonder, is that, you know, is that what we want to be doing? But when I expressed that thought out loud once to a Federal Reserve governor who had also been a banker, and who was sort of sympathetic to the notion of thinking about it, but also realized that in the midst of the crisis, it wasn't a good time to be thinking about it. So, and I think that that's the issue. Things go up and down a little bit. I don't think that we want people to, I mean, I do think that there's still probably a good liquidity reason for purchases to be considered. You know, the alternative would be to amend the regulation to only consider originations, and everybody gets all of a sudden, you know, a much lower sort of baseline to begin with. But I do think that—
Or you see more of the non-CRA regulated part of the industry doing mortgage lending.
Right. Well, and that's right. So there are all kinds of things with that. But I guess my point is, though, that when I read the regulation, it does not distinguish between those two things for the analysis that follows. And so that's what I would say the answer is. Do you guys know of anything else that—
Well, I would say I'd recommend that you ask your examiners to reach out to me and my team, and along with compliance risk policy, because we've been hearing a lot of stories from institutions that have been told by their examiners, for example, that they have to have HMDA loans in order to pass CRA. You know, so there are these mythologies that somehow, you know, and I don't know what the genesis of them all is, but you know, if we have a large community bank that was told this, for example, that their specialty is small consumer loans. They were also doing some very interesting things in the community development lending space that were proving to be very effective, but they were draining off about 50% of their resources to buy LMI loans at high premiums. And is this really what we're trying to accomplish through the regulation? And so telling people that there's nothing in the regulation that says you have to make HMDA loans, or you have to make small business loans, or that you have to purchase this or that in order to be able to be assessed on your performance. And so I think, you know, the issue becomes, particularly for those operations that are focused on wealth management, and so they don't necessarily have that natural inline to certain segments of the marketplace. How do you come up with ways of serving the entire community and the credit needs in those communities in a way that's beneficial and effective? And you know, what we've been saying repeatedly for within the OCC as we've had these discussions with banks is that we're open to working with you to find the creative solutions that are more effective than just facilitating that. You know, there's a certain amount of loans that just exist, and the same is true with MBSs, that exist on that treadmill where, you know, they're held until the examiners leave, the bank gets its PE, and then they're free to sell them. And, you know, I've had a couple of CRA officers tell me gleefully that, you know, they sold those for significant premiums. And, you know, recognizing that this isn't really what the objective is, but, you know, through some rather interesting machinations in terms of the way the process has been implemented, we seem to have ended up at this place that there is some misunderstanding about what is appropriate and applicable.
Robert? Oh, I'm sorry.
Hi, this is Jamie Weisberg from the Association for Neighborhood and Housing Development. Thank you for all the work you're putting into the new CRA regs. I'm actually really interested in the naturally occurring housing discussion going on. It's my understanding that, many banks get credit for, in New York City, we have a large stock of rent-regulated housing that is not rent-restricted, but when it's considered affordable, they get CRA credit for it. And we do want banks lending in this space, but we're really concerned about how the lending is done. So I'm curious how you're looking at that in other other high-cost markets. And I'm also interested in the high-cost section. I'm not sure if you're giving allowances for higher income renters, because in New York City, like 25% of the population is below 30% of AMI. So even in the high-cost market, we have a very low-income population that relies upon the rental housing stock, and certainly access to affordable home ownership up to the 80% AMI level. But yeah, so I'm curious how you're looking at the naturally occurring discussion, and so especially if it's not rent deed restricted, that there be a real emphasis on keeping the homes affordable, particularly in high pressure markets where lower income tenants are being pushed out. So.
It's my understanding, right, that NAAHL is concerned about subsidized versus unsubsidized, and the unsubsidized housing is the
Yes.
the unsubsidized. I mean, the Q's and A's that we have out there for the general public really focus a lot on the subsidized housing, and I understand that NAAHL wants institutions that
More clarity.
more clarity around it, because we have. I mean, maybe I'm not completely understanding the question, right? We, as far as regulators, we have things in place for subsidized housing. For unsubsidized housing, if you make a mortgage right in a low-income community, you're getting CRA credit for it.
Or to a low-income person.
To a low-income person. I mean, so we already do that. I think the issue is that banks find some of the requirements for the non-subsidized space to be burdensome. You mentioned having to get a person's income. Some people would say that may not be as burdensome, right? Because I don't know who can rent a place without giving their income to.
Challenges for sure, and I don't envy you having to figure that out. I just ask, as you consider this, to also have the regulators consider how, once you've decided that this qualifies, that it stay affordable, and that the banks are attuned to how the loans are being made, particularly if there's not a deed restriction. So just another nuance in that unregulated market.
Or do you mean slumlords as opposed? I mean, I know that. No, that, okay. I'm not trying to be funny. I mean, is that what you're talking? Because I know you all put some stuff out. If that's what your concern is, I can address that. I'm sorry, I missed it.
I think there are two issues.
Okay, I was.
One certainly could be slum landlords, and I think in New York City, for example, there are a couple of sources of landlords who, and it's tracked by building, where they have zoning ordinance violations or other issues, tenant complaints, things of that nature. So that's a resource that banks have. I know it's a resource that we use to try to ensure that we're staying out of that space and we're not qualifying that type of lending for CRA purposes. So I think the slum landlord is the one component. The other component, though, is how do you ensure that those units are being kept in an affordable position over time. Did I get that right, Amy? Is that the second part?
Yeah.
Or should a city?
Yeah, see, I don't know how we do that. That's why. Yeah.
I heard, I was asked for a different reason to look at a conference that was just held in Minneapolis a week or so ago, and listen to, I'm going to hatchet his name, a law professor from the University of Minnesota, who did a very compelling discussion of how far down Minneapolis-St. Paul has come, from a stellar school system that was extremely integrated to one that is not, and then the mirror image in housing. And what I came away with, and I was listening for things that CRA could be doing better, but what really I came away with was a compelling reason why cities and states need to do some of this work.
Yeah.
There is only so much, and I'm not saying that we are not interested in figuring out how to help banks understand what we, and have you give us ideas as to what we could look at. But where, I mean, it's nice that New York City has these slumlord sources, but I'm not sure every city does.
Right.
I actually don't know, and it was a good
But the
question.
public policy component is really critical.
You can't,
Yeah.
yes,
Well,
and you can't, it's like asking the Federal Reserve to fix the economy by itself without fiscal
You don't?
policy. Maybe we do, but I'm not in that
I thought
section.
for a while you were.
But I mean, no, I do think that it's important to recognize how important CRA is, especially on the 40th anniversary, and how it remains important, but to realize also how, in many ways, it cannot do everything. And there's so much more that needs to be done, and I'm sure that that's what, you know, people are talking about at, I don't know, women's conferences in Detroit or something, I don't know. But, you know, I do think there's more to be done for the priority. I mean, you know, now I'm really going to get off on a tangent, but I was just telling a colleague who would love to move into Arlington, Virginia, but can't afford to, that I think I found her house because the feds want to seize Paul Manafort's house.
So there may be an opportunity.
Maybe that's why the prices are so high, and maybe we can all afford a house soon in Arlington. But anyway.
Well, thank you for that bit of humor. Patience.
Yeah, no, I mean,
Bobbie?
I recognize
Yeah.
your concern, and I do agree with Theresa on this, right? There's a role for state and local governments. I mean, I think, in NAAHL's recommendation, you said something about you take a look at it if it's affordable and make sure it's affordable to the individuals for the life of the loan. But let's say you get...
That is one of the components. It's like there are 3 different tests, and one of them is whether that landlord is basically agreeing to keep the units affordable.
For the lifetime of their loan.
Of the loan,
But if they sell
yes.
it, right, that's the... Right, I mean, that's only for as long as they own the building. Yeah, so
right.
that can be a shortcoming. It's only for as long as...
But,
it isn't the financing period.
Right, but when you look at it from a CRA perspective, I mean, we are talking about the financing component for that building as well. Yes.
Yeah, and I
If it's very
think,
temporary, it could be a problem, that's all.
you know, one of the things that I bear in mind is that, you know, OCC has a very specific set of missions. And, you know, one is the safety and soundness of the industry. The other is consumer interests. And, you know, we have finite resources to accomplish those missions. And, you know, we certainly have regulatory mandates to look at certain things. I agree with both Patience and Theresa that, you know, there is a role for local governments in that portion of the activity. But even beyond our roles as regulators of the banking industry, you know, I've read an awful lot over the last 10 years now about the incursion of private equity funding into the rental housing space. You know, California and Las Vegas, massive swatches of single-family homes purchased by these equity funds that continue 10 years later to rent them out. And, you know, they aren't returning them to the housing stock that's available for purchase because they can make a significant amount more money by renting them out over time than by selling them back into the, you know, into the real estate market. And those entities aren't regulated in that manner. And they've certainly also been active in places like New York City and Chicago and buying large multifamily buildings. And, you know, one of the things that I'm concerned about doing too is that if we place too many requirements on the banking industry to do this kind of lending and set expectations way beyond what's expected of other sectors of the business, you'll simply exit the segment of the business and it will be solely left to the people who don't have this same focal point.
Very good point. Robert, and then Jan, if you want to get the mics prepped, or the mic prepped.
Hi, Robert Manuel from Wells Fargo. You know, back to the question that Bobbie posed with regards to loans purchased. Keep in mind that banks are doing this because they feel that there are gaps or weaknesses in their performance based on, let's say, unpublished benchmarks, whether it's with regards to a percentage of demographics or percentage of peers or even a percentage of prorated, you know, tier 1. The fact that banks aren't meeting those targets based on past practice and past guidance, we feel we need to purchase MBSs or we need to purchase loans in order to improve that performance. So first of all, I applaud and encouraged by your comments about really taking a thoughtful approach to this revised guidance, because I think that'll really help with the clarity. But back to the whole notion of benchmarks, quantitative benchmarks, whether published or not. How or if and how will that possibly be reflected then in examiner guidance? If you're not going to be using these types of benchmarks to assess performance, then what are we going to have in lieu of that?
So what are the objective measurements?
Yeah, well, the first point I'd like to make on those quantitative benchmarks is that, contrary to popular opinion that they're objective, they are not objective. They, in the cases where I've seen them, they've been established based on an examiner's perception of what they're used to typically seeing occurring, which can differ from another examiner's set of experiences, which differ. So when we look at some of these tools that examiners have developed in the field over the years that they use to try and make this a very objective process, the very underlying element, the starting point, is their own subjectivity. And so we need to dispel the notion that these are objective criteria that have been set. They haven't been set by the agency. The agency doesn't endorse benchmarks. What we are trying to do, the Tier 1 capital is a very good point. It almost brings me to want to quote, "I have a dream," because I really am aspiring to the day where part of my mission is to push forward with this. Let's look at the objective numbers. So let's look at your performance against that demographic and against the aggregate performance, but then understand what's driving differences between those three, rather than simply focusing on, well, this one divided by that one comes out to 1.01, therefore it's excellent. And this one is divided by that one comes out to 0.901, and so that's terrible. We have no objective basis for those numerical relationships. And so if we can get away from that and focus more on looking at the underlying reasons. I've been overseeing this PE review process in the agency for over 2 years now. And I had a slew, because of the fair lending and illegal credit practice issues, that OCC had a policy of not finalizing a PE until it was, and we've changed that policy.
Thank you.
Yeah, so now they'll get out. If there are issues, they may get mentioned, the PEs get issued, but we'll wait for the later day when it's resolved to determine whether there's an impact. But, not to get on that tangent, just really in that population of bottlenecked performance evaluations, many of which dated back to 8, 9, 10, 11 performance period, not one of those PEs mentioned the recession. Not one. That is the most significant factor economically that affected banks' lending. And in cases where we did see things mentioned like, the unemployment rate went from 6% to 15% in Michigan and from 8% to 17% in Detroit, that was the end of the statement. There was no, what is the ramification for lending of that high unemployment number, that sudden change? Obviously, anybody in this room is going to know what that implication is, but I don't think the general public will automatically know that. And we need to be discussing that in the performance evaluation and making it clear that here are the factors that we understand drive the differences in the bank's numbers from the demographic and the aggregate. But very often, of course, OTS, I have a lot of experience with the aggregate data from my years at OTS. And very often, it was rare circumstances that we saw banks that were significantly different from the aggregate. And if they were significantly above, it was the Lehmans and the Merrills that were doing, or AIG, that were doing a lot of subprime. If they were significantly below, it was usually smaller institutions. There were reasons why. But the vast majority of banks were well within a reasonable range of the aggregate. And then if you understood why the aggregate looked the way it did relative to the demographic, you had the whole story. And you could explain why that performance was reasonable. You know, to expect a bank to achieve those demographic benchmarks, I'm not sure, particularly on the low-income end, that those numbers are really attainable. And so is that necessarily, you know, and this is me speaking, you know, is that really a realistic goal? And so that's something that I'm trying to, in my role, push forward. Let's take a rational look at the information we have and fully explain what it is. And, you know, the banks, I think in this room, all of the banks do a tremendous job of providing us performance context information. You understand your markets, you understand why you're doing what you're doing. Let's move that story all the way through the analysis into the evaluation and the written PE.
Jan.
Hi, thanks for coming. We always enjoy hearing your perspectives. It is, to many of us, the most valuable parts of these meetings. I couldn't resist revisiting what Bobbie brought up and also Robert from Wells Fargo, and that is to do with the originations and purchases. The regs allow them both to have equal credit now, and I would be a strong proponent in keeping it that way. And I think that sometimes purchase of MBS and bulk mortgages for LMI people gets a bad rap. And here's why. I, in the last 14 years, have managed billions of dollars of purchases of MBS for LMI and also whole mortgages. And because I've always worked at banks that didn't have just a normal lending program, I've always worked at banks without branches, the purchase of an MBS or a mortgage is the only way our bank is able to participate in the affordable single-family residential mortgage market. And what you need to understand is all of those have always been in my CRA portfolio. We have a P&L within our bank. And when we buy those, we pay significant premiums. So the thought of you can buy and pump and dump and make money may sound easy and glib, but over the last 14 years, there's only been 2 occasions when I've ever okayed the sale of a mortgage-backed security or a low LMI mortgage because our bank had to pay such a high premium, we're talking anywhere from 105 to 110, that under accounting rules, you have to amortize that premium. So you have to hold it X number of years before you're even going to get even for paying that premium. Then if you are having a rising rate environment, you'd have to sell it at a discount. So I just felt it really important to help correct the misunderstanding. The MBS, purchase of MBS or LMI mortgages is an easy way. It's very expensive, and you have to work hand in glove with your capital markets team to manage the interest rate risk and also the unrealized losses that accrue in a rising rate environment. So please, no, it's not a cheap and easy way to meet CRA. It's actually very expensive for banks. And I've talked to fellow CRA officers who wanted to sell their MBS after an exam, and most often it's at a loss because of that premium you pay up front. And the 1 or 2 year exam period is not a long enough holding period to amortize that premium. So that may be more arcane detail than you're interested in, but it's a reality for us. And I think it's really important to keep equal value given to purchases, especially for banks like mine, where it's our only way to participate in that market.
Yeah, and I wasn't meaning to imply that MBSs have no value in the space. You know, and when we're talking to examiners and when they're doing their reviews and assessing the investment, you know, if the bank is investing in these to hold the securities, that's of greater significance, greater value to us. And so that's one of those qualitative differences. You know, so but when we've done exams, we've seen some places that have purchased the MBS when the loans were relatively new, they bought in the initial offering and have been holding those. In other cases, we see banks that, last year they bought an MBS, and when you look at the underlying mortgages, they're 8 or 9 or 10, and one example, 14 years old. And so then the question is, I always call the CRA regulations the Janet Jackson regulation. What have you done for me lately? So the question with those types of transactions is, what does that do for the borrower who got that loan 14 years ago or 8 years ago? And is it really meeting a need? Now, if you're holding them, in portfolio, as part of your investment portfolio, that's a different issue from the, I'm talking specifically about the segment that goes on and that has been driven to a large degree by this requirement that Robert was raising about, having these tier 1 capital benchmarks that again are something that as an agency we have never sanctioned. And none of the agencies have ever sanctioned using benchmarks. Examiners do it because it gives them a comfort level. Because a lot of our examiners who do CRA, well, you have to pass an accounting test to get into the pre-com program. And so when you take that experience as an accountant, as a credit analyst, to then go into this qualitative world of CRA, and they're uncomfortable with it. So they try to quantify it, but then that's created these incentives for bank staff to say, well, I have to meet 10% because that's the only way I'm going to get an outstanding on the investment test. And that's the sort of thing that we want to try and get away from.
I think we have a question. Oh.
Yeah, Doug Craycraft, JP Morgan Chase. I want to go back and clarify something that we talked about earlier, the combining of the HMDA loan purposes for your exam. So is there kind of a start date for that, when that's going to kick in, or do banks have an option to do that today, or banks that may have an exam starting next year, could they do it either way? Could they keep them separate or combine them? Where are we at as far as the timing of when that kicks in?
You mean in terms of combining
Like
home purchase and refi?
home improvement, refi into total HMDA for the exam?
I can't give you the exact date because I don't know when the review of that policy is going to be finalized, and that will determine what the date is for the actual transition to that. But we are going to go to that combined format. We've actually done analysis that shows that there isn't any substantive difference in the ratings that result from the combined analysis. The reality is we really don't have the resources to continue to do the evaluations and be able to do them timely. So, it's a matter of making choices about what we have the resources to accomplish and do it in a manner that's helpful to the industry.
So I might have to, I don't know whether, do you want to say something or do you want me to say something? I'm not sure we're going to go that way.
Yeah.
When I spoke to my examiners, there is a distinct concern, especially as it relates to CRA, that the loans that are most responsive to community needs are often a particular type, not necessarily a refi, but a home purchase. A home improvement loan, which for some of the OCC regulated entities.
Well, but home improvement won't be reportable going forward.
Well,
If it's
as a separate
unsecured.
category.
Unsecured.
Yeah.
right.
The unsecured one, yeah.
So, but the point being that by not separating things out, our concern is, and we have not, this discussion's not over, obviously, but our concern is we do them separately now, and that in terms of CRA responsiveness to community needs, that there's a compelling reason to perhaps continue to sort some things out. Now, mind you, I understand the OCC's resource constraints and the size of their institutions. I just don't want anybody to walk away with having
The impression.
thought that, with the
yeah.
impression that what Bobbie is talking about is necessarily going to be adopted on an interagency basis. I think it's too early to say that.
Yeah.
And Patience is shaking her head.
Yeah,
so-
right. I'm in the middle, figuratively and literally, in the in the middle on this particular issue, right? We sometimes combine, sometimes we don't combine, but there have been a number of discussions within the interagency group on how to approach this, and we have not reached a consensus.
And that sometimes
Yeah, and
it's
there's
often about volume of
Yeah.
lending for smaller institutions,
Yeah.
too.
yes.
So,
So we don't know
is
how
it-
we'll be doing this going forward.
I guess there might be two solutions to this then.
You've always got two solutions.
Well, at least two, yes, at least.
I like to work in threes, but go on.
Okay, well, two that I can think of off the top of my head, and if you don't let me tell them, Teresa, I'll probably forget them.
All right.
Because my memory's not as good as
I'm
it
writing
used to
them
be.
down.
But one, is there the possibility, though, even though you're trying to work through the examiner guidance, of having a consistent approach through all three agencies, that there are still some areas where you don't reach consensus, you probably can't reach consensus, and instead of slowing the process down, you accept those differences. That's one. Or the alternative there is that you build enough flexibility into what your answer is so that it's not, just this is the only way that it can be done.
We're actually doing both.
Yeah, I think those are-
Yeah, they're not mutually exclusive.
So
We're doing
both
that
of those,
depending on the
both of
particular
those are
issue.
possibilities?
Yes.
Yes.
Okay.
I
Good.
think that
Taking both
on big
approaches.
issues, though, the flexibility in the answer, our examiners are saying things that I imagine bankers would say, which is, that's just not helpful. And,
Well, I
so-
think, though, if you leave it to
It
the
depends on
bank
what it is.
in terms of options also, could be part of that.
Well, that's,
No.
it depends on
Yeah,
your
we have
perspective.
intermediate small banks that have 20 rating areas and, 40 to 60 assessment areas within those rating areas. We have large banks in the mid-size and large bank space that, they're in 10, 20, 30 states. We've got places with 240 assessment areas, 300, 400 assessment areas. And that makes it very challenging to do that in a timely manner if we stratify out every possible element that we could look at. And the question then arises, if we're not seeing a significant difference in our
The outcomes,
conclusions about
right.
your performance, is that
How much does
difference
it
really
matter?
that significant? And even for many of our mid-sized banks, and certainly the smaller banks, once you stratify, many of our mid-sized banks are heavily concentrated in a few areas, but they have a broad-reaching branch network over, say 10 states. And when you stratify it out, they have 19 home purchase loans and 13 refinances and 2 home improvement loans. And we can't do anything in terms of the distribution analysis because those numbers are just too small, whereas combined, we can at least have enough mass to say, well, we have X amount of certainty that this is reflective of the bank's lending.
Yeah, I think that on the volume issue, there is a good case to be made.
Well, and I think it's indicative of the case that there's not one size that fits all either. And as we started out, CRA is a very complicated business, a lot of nuances. You all were very successful in running out the clock, so I didn't get to put you on the hot seat about specialized CRA examiners. So we'll follow up on that the next opportunity that we have. But please join me in thanking our panelists here.